Welcome to Lecture 1 in this lecture series on the subject of Principles of Insurance IC01. This lecture series is based on the syllabus fixed by the Insurance Institute of India in 2025. This lecture series is designed to help those people who would like to watch and listen to lectures to understand the subject and write the exam conducted by the Insurance Institute of India. Previous 5 videos on old syllabus can be accessed from the links provided in the description to this video. Since the last lectures were posted, there are substantial changes in the syllabus of IC01. Chapter 1 is now titled Introduction to Insurance. However, the content of those previous lectures would be useful. Hence, you may access those videos to have an overview of the subject. Now, coming to this lecture, first we deal with loss. Loss due to an event can affect a specific number of people. The chance of losses can be predicted to an extent based on experience of the past. With the advent of computers, data, statistical modeling, and recently AI, the predictions have become more and more robust. These aspects have enabled creation of insurance, where the economic loss of a limited number of persons would be shared by a large group of persons. Small contributions called premiums are collected from a large number of people and are pooled into a common fund. Those who suffer losses get compensated from that common fund. Just an additional information which may not be relevant for your exams. The US National Association of Insurance Commissioners NAIC defines insurance as an economic device transferring risk from an individual to a company and reducing the uncertainty of risk via pooling. Note the importance of pooling in the definition. Now, let us come to the concept of risk. What is risk? It is when an unexpected outcome occurs or did not take place. Many things in nature are normal and usual, such as sun rising in the east and setting in the west, day and night, and so on. But many events do not happen as expected. Even in nature, it is not sure if it is going to rain tomorrow or even now. Also, it is not sure whether we or our family members will stay healthy forever and will never get sick. Likewise, it is not sure if there would not be a fire in the building we live in or that a vehicle might not get involved in an accident. So, in all these uncertain events we mentioned, there is an expected outcome, as noted in the textbook, or more precisely, a desired outcome. However, there is a deviation from the expected or desired outcome. If this deviation is adverse to the expected or desired outcome, it is known as adverse deviation. Now, this deviation may result in a loss or not. If it results in a financial loss, then there is a possibility of addressing such loss through insurance. There could be other losses such as emotional loss, sentimental loss, etc., which cannot be addressed by insurance. So, what is risk? It is the possibility of an adverse deviation from an expected or desired outcome resulting in financial loss. So, there are 3 ingredients here. 1. Expected or desired outcome. 2. Adverse deviation. And 3. Financial loss. Please remember these 3 ingredients as they are important from an exam point of view. Now, let us come to the topic of pure and speculative risks. The distinction is important to understand because pure risks are covered by insurance and speculative risks are usually not. Now, pure risks are situations where there are only two outcomes, either loss or no loss. There is no possibility of gain. Take, for example, the following situations. A vehicle on the road may reach its destination, in which case there is no loss, or might meet with an accident, in case there is loss. A person could be fined throughout a year, in which case there is no loss, or he might get ill and be hospitalized. In that case, there is a loss. Likewise, a machinery could run properly or smoothly without any loss, or it could break down, causing loss. A shop could be safe without any problem and no loss, or could get burgled in that case there is loss. So what we see in all these examples, pure risks do not need a voluntary action on the part of the person to be triggered. It is triggered due to factors beyond the control of the person suffering. A machinery may undergo breakdown not due to the person operating it. A vehicle might meet with an accident not because the driver was negligent, but because of some other person. A person could die because of a coconut falling on his head. Here, he does not have any control over the situation. Thus, we see that pure risks have two characteristics. One, they occur due to factors beyond the control of the person suffering the loss. They have only two outcomes, no loss or loss. Speculative risks, on the other hand, may lead to three outcomes, no loss, loss, or gain or profit. Let's see a few examples. Ravi buys 100 shares in the share market of a particular company at rupees 300 per share. 1 month later, the price per share of that company is only 200 rupees. Thus, there is a loss of 100 per share, that is 300 minus 200. 1 month later, the price per share moves to 500 rupees, which is 200 rupees more than the price at which Ravi bought the shares initially, thereby making a profit or gain. See another example. Ravi puts a bet in the cricket match between India and Sri Lanka in favor of India winning. If India loses, Ravi might lose the bet money, but if India wins, he will win the bet money. There is therefore a chance of gain in this transaction. Speculative risks are undertaken voluntarily. The textbook lists some examples and classifies them as speculative risks, such as change in market demand, change in fashion, change in government policy, change in tax rates, change in interest rates, change in foreign exchange rates, and competition. How the above speculative risks are voluntary is doubtable, but they are not within the control of the person suffering the loss. Perhaps the difference lies in undertaking a particular activity and suffering losses on account of, say, foreign exchange rates difference. For example, Ravi and Chiang, two persons, may agree today that Ravi will sell his goods worth 1000 yuan to Chiang by delivering it today, and Chiang will pay Ravi the price 2 months later. Today the value of 1 yuan could be rupees 12.17. 2 months later it could be 11.35, in which case Ravi would stand to lose about rupees 820. See, the value of goods in rupees today is 1000. 1000 is the value of the goods sold in yuan, multiplied by 12.17. That is the exchange rate, which is 12,170. So the value of goods in rupees today is 12,170. But because of the reduction in exchange rate, the value of the goods in rupees 2 months later would be 1000 into 11.35, that is 11,350. So in terms of what Ravi could lose is about 12,170 minus 11,350, that is 820 rupees. If you want, you can work it out on a piece of paper or an Excel. This example may not be a speculative risk because the increase or decrease in exchange rate may not be within the control of Ravi or Chiang. But if Ravi engages in an exchange rate trading, he voluntarily undertakes it, and so the risk is speculative risk. So we can note the distinction between pure and speculative risk in the following manner. Outcome. In pure risk, there is loss or no loss, but in speculative risk, there is loss, no loss, or gain. The domain of control in pure risk is outside. That is, it is caused beyond factors that are not within the control of the person suffering loss. Whereas in speculative risks, it is within the control of the person. And pure risks are covered by insurance, speculative risks are not covered by insurance. Pure risk, the choice is involuntary, whereas in speculative risk, the choice is voluntary or conscious. Examples of pure risk could be accidents, fire, death, illness, natural disasters, etc. Speculative risk could be share market trading, exchange rate trading, gambling, etc. Now, the difference between pure risk and speculative risk is important. Just an additional information, Section 30 of the Indian Contract Act 1872 provides or declares many of the speculative risks are contractually void, though not all are. It uses the term wagering agreements. Right. So if two parties enter into a speculative transaction, then the contract is void. Coming back, the focus of insurance is on pure risks. If speculative risks are focused, then it will lead to following problems. Speculative risks are voluntary. If insurance compensates these losses, then more and more people will end up in speculations, which will lead to considerable losses and will destroy the very essence or purpose of insurance. People will not be willing to share their profits from speculative transactions. Predictability in speculative transaction is a challenge. There is lack of acceptable standards to predict probability of outcome. The society runs on the principle of no risk, no gain. An enterprise in insurance will not thrive if insurance would exist for speculative risks. So that's all in this lecture. We will discuss risk management and risk retention in the next lecture. Bye bye and take care.